Today we're taking a look at a stock with a dividend yield of almost 10%, and it's a stock that hardly anyone has on their radar. I was made aware of it on my analysis platform, where a member suggested this very stock, and since I find it interesting, I thought I'd make a video about it myself. If you also want to discover interesting stock ideas and analyses from me, as well as keep up with my buys and sells, feel free to check out my analysis platform. The link is in the video description. And which stock are we talking about? It's the Scandinavian Tobacco Group. Here we can see the stock chart from the past few years, starting in 2016. At first, it went up from 13 euros to about 17 euros here. Then it dropped again, significantly, down to just under 10 euros during the Corona crash. And after the Corona crash, it shot up by a good 100% to over 20 euros. Since then, starting in 2022, it's been steadily going down again, down 40% to 12 euros by now. And of course, you also have to keep in mind that there have always been high dividends over all these years. So overall, you generally did pretty well with this investment, unless you happen to buy at the peak prices. But as we can see, we're actually not that far from the lows anymore. Back then it was around 10 euros, and now it's about 12 euros, which could be a nice entry opportunity. And that's exactly what we want to take a look at today. We see the current market capitalization is at 7.2 billion Danish kroner. So, this is the Danish company, and of course they're active in the tobacco market, but not in the cigarette market. Instead, they're more focused on cigars and pipe tobacco, and the group has around 10,000 employees worldwide. We have sales offices in North America and Europe, and we distribute our products in around 100 markets. In the US, through our stakes in General Cigar and Cigars International, we are the market leader in handmade cigars as well as in catalog and online sales. Overall, the portfolio includes 200 leading brands, including cigar brands, which they have listed here in more detail. I'm not going to go into the individual brands now. I'm not a smoker either, so I'm not very familiar with this. Feel free to take a look through here if you know more about this. They really have quite a lot to offer. And of course, the advantage of this business model is that there are very low research and development costs. You generally don't have to invest much here. On the other hand, the downside is that the entire tobacco market, at least in industrialized nations, is declining as fewer and fewer people smoke, especially cigars. However, there is still a very large customer base worldwide. That's why the company still generates quite a bit of revenue, as we'll see in a moment. So let's take a look at the long-term development. In 2012, revenue was still 6 billion Danish kroner. Since then, that has increased by about 50% to over 9 billion Danish kroner. Net profit rose from 600 million to 1.5 billion in 2022, and since then it has declined, just like the stock price, which has also dropped from 20 euros to 12 euros now. Currently, it's still at 800 million here, and the free cash flow has been positive the whole time. Back then it was 300 million. Then at times over 1 billion, and they've managed to maintain it, currently still at a solid 1 billion Danish kroner in free cash flow. If you compare that, the market capitalization is 7 billion, so the price to free cash flow ratio is just 7. And what do they do with the profit? They don't need it for research and development, so instead, they pay out high dividends. The numbers aren't exact, but they're close. We'll look at the exact dividend payout figures later. Here, it's about 8.5 Danish kroner currently, or at least most recently, which at the current share price is almost a 10% dividend yield. And they're buying back their own shares, as we can see here. A few years ago, there was still 100 million shares outstanding. Now, with 78 million, that's actually more than 20% less. So, they're really doing a lot for the shareholders here. And they even state on their website that this is how things are supposed to continue. The goal of the board of directors is to distribute excess capital through share buybacks and/or dividends, with the aim of increasing dividend payments annually. So, they actually want to keep increasing the dividends, even though they're already at nearly 10% dividend yield. And here we can also see the exact development. Back in 2016, the payout was 5 Danish kroner, and today it's 8.5 Danish kroner. There was a jump here in 2017, but that was due to a special dividend that was paid out, amounting to 3.5 Danish kroner. Actually, it was only 5.5, and if you leave out this special dividend, then over the last 10 years there have been continuous increases. So the dividend kept being raised, even if most recently it was only by 0.1 Danish kroner. But still, the payout itself is already very high now. There are also several anchor shareholders, so just over 50% of the shares are in free float, and then there are several major shareholders. Here, with over 25% of the shares, is Augustinus Fabriker, and then again over 10%, and twice over 5%. So here too, There are major shareholders who are interested in the long-term success of the company, and this year there were even insider purchases, here in May and again last year in November, for various amounts. Here, for example, 200,000 Danish kroner, 500,000, 200,000, and again 165,000. However, these were at prices that were higher back then than they are now. That means you can now buy in at a better price than the insiders themselves did. And then let's take a look at the current half-year 2025 financial report. We see here that in quarter 2, revenue was at 2.361 billion Danish kroner. Last year it was 2.366 billion, so it has gone down just slightly. Net profit dropped more significantly, from 297 million to 227 million, and free cash flow was also quite a bit lower, going from 129 to 119 million Danish kroner. And on the right, we can also see the 6-month overview. So, free cash flow amounts to 271 million in the first half of the year. Last year, it was still minus 34 million here. If we scroll down a bit further, we see the outlook on page 6. And what is the company expecting in 2025? They are expecting revenues of 9.1 to 9.5 billion Danish kroner, and a free cash flow of 0.8 to 1 billion Danish kroner. This means that here too, the price to free cash flow ratio is roughly between 7 and 10, depending on which numbers are achieved. So, there will continue to be high free cash flows generated, which in turn makes it possible to pay out dividends. Earnings per share are expected to be between 10 and 13 Danish kroner, which is about €1.30 to €1.70. So, the P ratio here is definitely well below 10 as well. And of course, we also take a look at the financial situation. What does that look like? We see that, on the one hand, they have cash down here 68 million, so very little. But they have a very high inventory of 3.6 billion Danish kroner. They also have a high amount of goodwill. I wouldn't pay much attention to that here, as it's probably due to acquisitions and gets written down from time to time, year after year or quarter by quarter. But as I said, very, very high inventory levels, which is of course also a disadvantage, because they first have to produce and purchase a lot in advance in order to sell it at some point later. And that ties up capital, and that's why they've also taken on debt. We can see that here on the liability side, namely that they have 3.2 billion in long-term financial debt, and another 2 billion in short-term debt. That means, in total, over 5 billion in financial debt. These are interest payments that are due here, repayment installments, and also a certain risk, because with a market capitalization of 7 billion and another 5 billion in financial debt, and a free cash flow of, well, just under 1 billion, that means it will also take 5 or 6 years before these debts can be paid off. If you were to use all the free cash flow for that, you would of course have to completely cut the dividend and also share buyback programs. That probably won't happen. That's why they will continue to have this debt, and maybe only pay it down at a very moderate pace, or maybe not at all, because so much is being paid out. And that's also one of the company's major disadvantages, the high level of debt. And the other disadvantage is that they're operating in an industry that isn't experiencing significant growth. Even though they've grown over the past 10 years, there's a risk that the next 10 years could look different, and the business might even decline. Whether it will come to that, I don't know, but we can take a closer look at the past few years here. We can see that revenue increased from 8 billion to 9.2 billion, but net profit has dropped to below 1 billion. Most recently, free cash flow was 355 million. Back in 2021 and 2022, it was still over 1 billion. However, this was due to acquisitions. They're trying to stabilize the business through acquisitions, but of course, that costs money. Down here we can see the free cash flow before acquisitions, and that's been around 1 billion every year, or even as high as 1.4 billion 4 or 5 years ago, but it's been steadily declining since then. And here we can also see the dividend payout ratio. Most recently, nearly 80% of profits were paid out as dividends. A year earlier, it was 62%, and before that, just over 50%. In 2020, it was almost 100%, with part of that still going into share buybacks. Those have dropped from 100 million back in 2020 to now 82 million. That was the status as of December 31st. Recently, more shares have been bought back. So, they're really doing a lot for shareholders here, which is why this is definitely a very interesting company for dividend hunters. Personally, I'm not just after dividends here. For me, a healthy financial situation is usually important as well, especially when you're operating in a market that isn't growing all that much. And that's why I'm not personally invested here myself. So, see you next time.